How do you protect your retirement from a market crash? It's a fair question, especially when markets feel uncertain as they are right now. But before we talk about protection, I want to reframe the question a little bit. If you're trying to avoid market declines entirely, that usually creates a bigger set of problems than it solves. The reality is market declines, they're a normal part of investing. And historically, the market has been up more than it's been down. And bull markets tend to last longer than bear markets. The average bull market is 4 to 6 years. The average bear market, 9 to 18 months. So we recommend to our clients that the goal isn't to eliminate downturns, it's to build a plan that can handle them. One of the biggest risks that you have, especially in retirement, is something that's called the sequence of returns risk. Simply put, that means the risk of taking money out of things at the wrong time. So as you near or enter retirement, the timing of market returns really matters. So if the market drops early in retirement and you're taking withdrawals at the same time, you're selling investments while they're down. That's no good. That combination can put pressure on a portfolio in a way that's hard to recover from, even when markets rebound later. So it's also important to keep perspective. As we talked about, markets don't go down forever, and on average, the market's up more than it is down, and the majority of your growth in your portfolio over time comes during periods of bull markets. So you have to stay invested in order to take advantage of that. So while downturns can feel significant in the moment, they're temporary, while growth has historically been persistent. So how do you actually protect your retirement? It's not about trying to time the market, it's about structure. And then that usually includes having a good cash or short-term reserve so you're not forced to sell investments during market downturns, and you're making sure to structure your withdrawals thoughtfully. You also want to make sure that you're managing your risk based on what you're comfortable with and the timeline of when you need to take money out of your portfolio. This all also needs to be coordinated with taxes and income sources like Social Security and pension. So in other words, protection comes from planning. It doesn't come from prediction. And no one has a good crystal ball that works. So a well-built plan doesn't assume that markets are always going to cooperate. In fact, it assumes markets are going to decline from time to time. So if this is something you've been thinking about, we'd be glad to walk through what that looks like with your situation, your numbers, no pressure, just clarity. And you can reach out to our team at Paladin Financial, and we'd be glad to build a plan based on your personal situation. If you find this content helpful, breaking down real financial questions in a clear, practical way, go ahead and subscribe or follow so you don't miss out on future videos.